Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next, I'm going to say 20 minutes. We're going to be short and sweet here on Options Guide TV today. Today is Wednesday, March 20th. The markets are open and they are rocking and rolling. I'm going to jump right into it as far as managing our paper trading portfolio. We talked a little bit about this on Monday. We put on a position on Friday in Amazon. So we added to the paper trading portfolio inside the TradeHawk software. In the paper trading portfolio, I don't get quotes on the S&P 500 index. So what I'm showing you right now is a screenshot because we have a concern in that Google had some good news coming out. So I'm going to put my little cursor over by the Google position, and you'll see that there is a red in the money that is being highlighted next to our short call position. So we finally heard something about AI and Google and got a little affirmation when Apple signed a contract with Google, first of all, making them once again the main search engine inside the iPhones, but talked a little bit more about their Genesis AI platform and using some of that as a movement forward with Apple. So what actually happened as soon as the announcement came out is Apple actually went down a little bit, and it really boosted Google because basically the marketplace took it as Apple thinks that they are making headways in the AI space. And if Apple thinks so, maybe we have misjudged Google a little bit. And that is the small synopsis of why Google had a real strong run up. And right now, Google is trading right around 147, which makes this an at the money option contract. And I'm going to run to the actual playbook, and I'm going to highlight a section about rolling covered calls. Because the biggest thing about rolling a call position is that you don't want to wait too long. If it gets to, sometimes it's preemptive if you feel like there's some momentum. And in Google, you could have, because that's actually the news that we were kind of waiting on. Some hint as to what they're doing in the AI space. A lot of people are worried that if they don't get ahead of this, they could lose their domination that they have in the search, and AI could actually hurt them as far as search is concerned, and the browser space in general. So we got some news. Apple seems to like it. Stock ran up. We're now at 147. We might have done a preemptive roll, but we weren't on Options Guide TV at that time. But I don't mind doing it right now because Google's right at the strike price. If you get 4 or 5% in the money, it makes it very hard to do a roll and get it done for a decent net credit to the account. Because our goal with the roll is to go up in strike and out in time. And so I already went into the paper trading application. Like I mentioned, this is a screenshot that I'm showing you right now. And mainly because we also have a paper trade in the SPX, and we're going to look at that trade here shortly. But we need the quotes in the SPX to be able to look at that, and the paper trading app does not have SPX quotes. So with this mentioned, let's look at the trade that I already sent inside the paper trading app. If you look at Google, we have 4 option contracts. So the actual position inside the playbook is called the fig leaf. And that means that we have these deep in the money options with this expiration 303 days away. And that's where all of our deep in the money option contracts are at, 303 days away. And we sold 4 against it. So this is a surrogate for the stock, deep in the money, acting a lot like the stock. It is now positive. It was the only position of deep in the money option contracts that we put together in November, a little bit in January. We bought a few of them. that was actually not positive. Obviously, NVIDIA, we've even sold an option contract in NVIDIA because it was just dominating the portfolio, but that's up about 250%, that option contract is. And now we need to roll this position. We also have a position on Schwab, and Schwab has actually made a strong move recently in the banking space. But at this point in time, we're not getting the red in the money. So we're not quite there with Schwab. 69, I think, was the last quote that I saw. So it's somewhere around that range, but we got 8 days remaining on this. We might sell another call in Schwab because it's kind of been a little bit stagnant. A lot of these bigger financials right recently have done well, but they just definitely don't have the volatility of the other stocks that are in this position. Lilly has had a real strong move up. That's up about 34%. And Home Depot also has had a real strong move up. All right, so let's jump out of the paper trading portfolio, and I'm going to have to just use my tab feature here. So 1 second, let's jump out of it and go over to let's go to the TradeHawk software. Okay, so that was the roll. We sent that in Google. That roll got, well, actually, let's go back and look at that one last time because I actually didn't mention that. So the roll got filled for a net credit of 51 cents to the account. Well, that's where the midpoint was. I actually sent it in at a 60-cent net credit. The market might have moved before I took the screenshot, but we were trying to get 60 cents, but 50 cents is fine. And we went from the 328 out to 412. So this was the expiration. This was the entry. We were buying to close the 147 strike call. We went up and out in time to the 149, and we're selling to open that position, getting it done for a net credit to the account of 60 cents. So I guess I'll run over and we'll look at the options playbook, I think, to start. And we're going to highlight that, and then we'll look at what we did actually in the TradeHawk software. So if you go into the options playbook, and this is my website, optionsplaybook.com, and you go to managing positions, as you slide down in managing your positions, you'll see an introduction to rolling or rolling a covered call. Now, this talks about puts and calls. We're going to actually look right at the covered call. And since that is exactly what we're talking about. So with the covered call position, here's what you want to do to try to avoid assignment. And one of the things that's highlighted in here is when you want to think about doing a covered call. So if we scroll back up to the top, one of the biggest things with expiration approaching is stock's gone up to 92. The biggest thing is to do it before the stock gets too deep in the money. And that's what we highlight what I highlight inside this managing your position, and talks a lot about the rolling. But if the stock gets too deep in the money, it's very hard to do this and get a net credit in the account. You need some time premium in order to do that. So there's the section. This is your homework if you're doing some fig leaf positions or even covered call positions. But in the fig leaf, we really don't want to be assigned. So if you go to managing positions under the categories list, you will see this article on rolling covered calls. All right. So Control Tab. Let's go back now to the TradeHawk software. And I'll start by just pulling up Google. Let's talk a little bit about Google. And by the way, if you have any questions today, please put them in the chat box. I'm happy to try to address them. I'd like to make this as interactive a show as possible. So if you are on the Tradier YouTube platform, you can use that chat box and you can put a note in there, and we'll try to address your question during the show. Right now, so if I pull up Google and we went to the April expiration. So we have the March expiration right now. The 147 is what we were looking to do. So we were buying to close this option contract in Google. The stock is at 147.50. And we went out to April and we went up to the 149. So here's the moral to my story. If you're sitting on this and you start getting deeper and deeper in the money on that call option contract, that means that the market, as far as this chain would concern, is going to get more and more expensive. But the biggest thing is time premium. Once you get so much intrinsic value and very little time premium, it gets really hard to go further out in time and cover the cost of that by doing an out of the money option contract. So, for example, if we go back and we look at the March, the 149 is what we're selling. That's $2.37. And if the market was down to the 145 strike, just a couple of points in the money, you're already looking at a situation where that option contract only has 54 cents a time premium in it, and it's bidding 297 by 305. So what would we have to do? If it got deeper in the money and it was trading around 145, we'd have to go out to the April 12th or the April 19th and put out and go further and further out in time in order to sell an out of the money option that would pay for that in the money option that has a lot of intrinsic value. And that's that simple. Okay. So now let's go back to the SPX. And on Monday, if you want to review this, we decided we wanted to get bullish in the marketplace this week. So yesterday, the market just kind of fluttered around, but today we actually got a little bit more of a strong move. On Monday, the markets, we put the trade on around, Options Guide TV, which is 11 o'clock Eastern time. And the market was really strong in the morning, and then it faded a little bit going into the evening, but wasn't enough to really make it so that we needed to do the adjustment. So I would have rode it through Monday's move, even though it did go down after we put the trade on. And Tuesday, we just kind of hung around right where the market closed at on Monday. And now we're back up strong. So there was never an instance where we were going to roll this spread into a butterfly. So right now we have the long call spread. We got the 5160s selling the 5170s. And inside the options grid, it always highlights where the market is at. The market right now, the most at the money option contract is 5185. To be exact, we're 5183.25. Okay, we put this trade on. The market was trading for 570. It was right around the 5170 level. And the thing with this strategy that I've always, when I want to get bullish in the marketplace, this is one of the strategies I like to go to: selling the most at the money call option and buying an in the money option, paying less time premium because you're paying all intrinsic value for the 5160s and selling all the time premium, which is usually centered around the most at the money. This was trading for $5.70. So now we see it, and it's, let's call it 640. There you go. Midpoint is 640. So we could sell this and get out at 640. We're about 10 from where the market was at. We're looks like 13 points in the money. So the market has gone up from 5170 since we put the trade on to 5183. Call it 13 points. We are only up about what is that? 30, about 70 cents on the trade. Today, and I've mentioned this a lot on Options Guide TV, is where time decay really starts to kick in on the option contracts. And here's the biggest thing about doing a long call spread is that this option contract wants the market to go up. This option contract wants the market to go down. And we are deep in the money, but this is still a real expensive option contract. And I'm going to highlight the extrinsic value. You need this extrinsic value to go away in order to make the maximum on the spread. So you want to pay as little time premium for the 5170 as possible. So what's the moral to the story? Spreads don't max out until you get close to expiration, or the option contract gets so deep into money that it's all intrinsic value and no extrinsic value or time value. And I thought I would take the time. This is just kind of old tricks. And I think with options trading, it's best to show many ways a concept. We can run to the what if calculator and look at how it moves through time and the time decay and study the theta. But I like to just use the chains. So back in the day when brokerage firms didn't have the tools that they have, one of the ways that I would develop realistic expectations with my students and with my own trading is to just jump from expiration to expiration, look at if it went deeper in the money, what's going to happen to the option contract by looking at the here and now chain in the underlying that you were trading. So, for example, this won't max out until this goes away. If the market stays where it's at, we need this extrinsic value to go down quite a bit, and it's still $24. Look at what happens if we go from the March 22nd expiration, which is the way that we set up the trade, that is this Friday, down to the March 21st expiration. The extrinsic value goes down about $5. So, well, not quite $5. Well, yeah, it was $5. Okay. So it goes down to 2022 because this is that one option contract. And I still got the trade down here. So it's down. It goes from 24 something down to 2048. So that helps our spread if we're in the money. That was $5 of time premium that happens in 1 day's worth of decay. Now realize that the markets are still open. We still got a half day's trading going on. So we got basically a day and a half. If we go to this expiration, this is actually Wednesday, March 20th, 2024, when we're doing our Options Guide TV or my Options Guide TV. And if we look at this, now that option contract still has a boatload of time premium in it, right? It has $12.66. But look at the huge rate of decay, how it happens going from Wednesday, $25 down to, or I'm going, so the just expiration going from Friday, March 22nd, 1 day's worth of decay from this option contract, $25 to tomorrow's option contract. If everything stays the same, down to $20. That was $5 worth of decay. Now we're going to go from $20 to today's option contract, which would mean another day would have passed. And now you're looking at $12. And that was $8, but it's still not zero. So moral to the story in the SPX is it's hard to get the juice out of the option contracts. It's a beautiful thing if the market goes against you because it does allow you to adjust. You need premium in the option contracts to be able to adjust. But in this case, we're not knocking it out of the park on this trade, right? We're only 13 points in the money. It's not even it's a fraction of a percentage of the movement in the S&P 500 index, but we are still correct on our forecast so far. And because like I said, tomorrow this is going to look a lot better if the market just stays where it's at. But because of the way SPX option contracts hold their premium, we're not making as much on this trade as some people might think. We're only up, what was it again? So it's 570.30. We're only up 70 cents on the trade, but that's nothing to sneeze at. That's a solid gain. What would I do in this position? Just stay the course. Hopefully the market stays above 51.70. Look at it tomorrow. One of the things I might do, and I might have done this on Monday just in general, is to enter an order to sell this at 950 and put it in good till cancel. I like to have a sell order because the last 50 cents is really hard to get out of the SPX. And you bet you got $5.70 in on this trade. If you can sell this for $9.50, that's a very solid trade. So you're talking on a 1-by-1 spread. Your risk is $570, and you would be selling it for $950 less any commissions. Like that would be your scenario there. If we look at this position. I don't mind having that. On the downside, I'm going to get out of the trade. I'm going to adjust the trade. I'm not going to necessarily put a stop order to sell it on the downside, but I will do it on the upside. So this would be a trade that at this point in time, I would probably put this in and just send that to the floor just in case it happens. If the market does come down, and the fact that we didn't take our profit today, and all of a sudden we wake up tomorrow and it's trading down around 51.45, I still would adjust it. I would still look at that trade and make my adjustment. But right now I'm feeling good about where we're at, and we'll just leave it there. There is a question. All right, we got a few questions, so let me check them out. All right. Would you use the simulator to calculate the move based on deltas? All right, Wayne, longtime listener, go ahead and we can show that one. Let's put that one up in the. There we go. All right. Yes, you can use the simulator, Wayne, and that's fine. I'm just trying to teach it in many different ways. I like to use the real trains. I think it's very effective to show that there's $25 of extrinsic value, and if we go one more day, all of a sudden there's only $20 worth of extrinsic value. And that's real numbers using a short-term option. That shows you $5 of extrinsic value goes away. That's going to definitely boost this where this spread is at right now. So the simulator, or the what if calculator is what it's called in the TradeHawk software, that would definitely work in this scenario, and if you'd like to do it that way, but I think it's also good to show it in the real marketplace. Okay, and then another question that Wayne has. Let's put the first one up, which is, hey Brian, I have a Nike short strangle. Okay, 115 and 90 puts, 30 days. I'm profiting $70, but earnings are tomorrow. If the price drops to 90, how would you drops to 90, how would you check what my P&L would be? Well, okay, so if they have earnings tomorrow, Wayne, first of all, and you're doing a short strangle around an earnings report, that's a scary position. I would rather be in a condor. I'd rather buy the wings and protect myself. But the implied volatility is going to be a mystery. The closest thing that we can do to try to guess where implied volatility is going to go is to look at the historical volatility. So I'm going to pull up Nike right now. And come on. Okay. There we go. And so we're showing the March expiration at 112 and the historical is at 38. So you would expect the implied volatility to come back in line somewhere around here. It's just an educated guess as to where you would think that implied volatility would go. So you could look at the what if calculator, put the trade in, lower the vol back down to about 38, and try to make an educated guess on that position. That's the way that I would approach that trade if you're trying to figure it out after earnings. But Wayne, as you know, and I'm sure out of all the years that you've been coming to Options Guy TV and whatever we called it, or whatever title it was, that doing short strangles around earnings is a scary spot to be in, just because of the gaps openings and the gap opening and the gap after the earnings report. I said that kind of jankily. All right, so then we have another question. Let's look at the SPX long spread from JV. JV has been around and had a lot of questions. Let's toss that one in there. Okay, the long call spread. If I use a short put spread instead, what would be the adaptation if the market does not go up? Iron butterfly? Use a short put spread. So you're going to sell the short put spread. So the adaptation. So if I'm at 5160 and 5170. So if I'm doing the put side of things, I want it to stay above 51. Yeah, JV, that works. Iron butterfly. That's simple. That's simple. Playbook, it says 30 in the playbook. Thanks. Yeah, that's what I would look to do. If you were using the same adjustment that we've talked about here on the long call spreads, where you roll right into a standard butterfly only using calls, the adaptation, if you're using short put spreads instead, would to be an iron butterfly. Yep. Okay. Look at my first question. There you go. Will the short put with the short put spread, the play with time premium is more favorable for us than the long call spread? Well, no, honestly, JV, yeah, we just put that one up. In the options trading world, all it really is trade-offs. I don't necessarily think that if you do the short put spread that you're going to get a different rate of time decay. Put and call prices are always tied into one another. One of the benefits on the short put spread is that if you are correct on your forecast, you don't pay any commissions to get out of the trade, and you don't have to deal with any bid-ask spreads, because if the market goes up, you make the net credit to your account. Also with the short put spread, but then the exact opposite is true too. Though if the market goes down, then you're deeper in the money, and you got to your adjustments are a little tougher in that scenario. Okay, now that is the benefit, but ideally the profit and loss, if you adjust exactly the same at that point in time that you would have adjusted the long call spread, you should have very similar profit and loss statements as if you started with the long call spread. They're synthetically the exact same trade. It's all about paying a debit versus a credit. And I guess I can stop there, I think. I do not mind that you start with a short put spread. That does not bother me at all. It's just different. It's just that straightforward. So synthetic relationships basically mean no matter how you do the trade, when you're looking at a short put spread versus a long call spread, they're synthetically the same. The profit and loss, in theory, should be exactly the same if you adjust it at the exact same time. But don't mind if you do it that way. I think the main reason why, first of all, people like to deal with calls because it's easier to understand than a put. And then on top of it, the adjustment, we're going out and selling that net credit to the account. And I think it just makes people a little bit more comfortable to sell that second spread, bring in that net credit, and then do the math on how much overall risk that you have on the trade. All right. I think that sums it all up. And we're right at time. So any more questions, feel free to throw them in the chat box. And if not, thank you for coming to Options Guide TV. We'll be back this Friday for the next edition of Options Guide TV. And if you'd like to follow what I'm doing, please follow me on x.com. My handle is simple. It is at Brian Overby, which is my name. So hopefully we'll see you this Friday at 11 a.m. Eastern time for the next edition of Options Guide TV. Thanks for coming, everyone.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be accurate actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.